everyone, and welcome to our YouTube channel, Moneyline with Nancy at TV. In case you're not a subscriber yet, please do subscribe. Just press the subscribe button as well as turn on the notification bell so that you can get notifications when we upload our videos. Don't also forget to subscribe and join, follow, like our other social media platforms. Of course, you're seeing it right about now. Don't also forget to share this video across your platforms. Enjoy the video. All right, Mr. Albert Olaniyi Folorunsho joins me now. He's the managing consultant at Christine Pidado. Mr. Folorunsho, good morning and welcome to the program.
Good morning. How are you?
I'm very well, thank you. Let's get started. We're talking about this capital gains tax. It's generated a lot of controversy, misinformation, according to, at least to Taiwo Yedele, who is the chairman of the Presidential Fiscal and Tax Reforms Committee. Let me also say that you're part of that committee. So let's get started first. Yes, you know, because there are a lot of you in that committee. Let me start by asking you, what is the single most important conceptual shift that we will have from the old flat capital gains tax that we had and the new progressive, according to what we've been told, progressive linked structure? So speak to me about that. And if possible also, talk to us about the myth. What is the real thing?
All right. Thank you very much, Nancy. So the significant thing that has taken place in terms of the capital gains is the unification of the tax rate for both income and gain. Okay, the capital gains tax rate used to be 10% of the gain, while income tax was different. But the global perspective, or what is happening globally, is what we call the Pillar 2 arrangement by the OECD, where it is possible for the profit that has been generated from Nigeria and ordinarily liable to tax in Nigeria, okay, will be subjected to tax in another country. The provision of the OECD under the Pillar 2 arrangement or scheme, under the inclusive arrangement which Nigeria signed into, is that where you are a member of a multinational company and the turnover of that company is not less than 750 million euro in a particular year, 750 million euro. The minimum tax that every member, every company that is a member of that group must pay is 15% of the profit before tax. And that is what we refer to as the global minimum tax. So which means if a company is in Nigeria or generates income from Nigeria and is a member of that group and fails to pay the global minimum tax in Nigeria, the difference between whatever tax the person paid in Nigeria will be paid in the home country of that company. And so Nigeria tried to unify the applicable rate for both gain and income so that whatever income is generated from Nigeria will have been subjected to tax in Nigeria, because the source is where tax applied first before where the person is resident. So a company that is not resident in Nigeria, incorporated in another country or managed in another country fully, may not ordinarily be liable to tax except they generate income from Nigeria. So one of those income they generate from Nigeria is capital gain. And so that is the main reason for the increase in the rate of capital gains tax, which is to make it the same with that of income tax. The unfortunate thing is that our corporate tax is still on the high side.
High side, yes.
Which is 30%. Even though there is also a provision in the law that says that this can come down to about 25% if it is approved by NEC through an executive order issued by the finance minister, and that can be 25%. But even the 25%
is high
as far as capital gains tax is still on the high side. Even if we are trying to align with this global minimum tax that I just mentioned, maybe the rate should not be more than that 15%, which is the minimum tax, that the OECD expects that such companies should pay to the country of source in order to reduce the base erosion and profit shifting that has been plaguing African countries.
Okay, Mr.
That is the
Folorunsho.
background to the increase.
Yeah, so Mr. Folorunsho, for clarity purposes, because I do understand that these tax matters are very complex and technical, and not all of us are tax, are tax experts, consultants, or practitioners.
Okay.
So for clarification purposes, what is the new CGT right now?
Okay, the new CGT rate is dependent on who is earning the CGT. I mean, is earning the gain, either an individual or a company.
Yes.
So for companies, the CGT rate, whether you are an ordinary company or a company in the oil and gas sector, the new CGT rate is the corporate tax rate, which is 30%.
Which is 30%.
While for 30%. While for individual, the CGT rate is the personal tax rate of the individual, and which means if you are a high income earner, with the highest rate for individual is 25%. The lowest rate is 0%. So which means if the gain you are making is below 1 million, or maybe your total income, including the gain, is below 800,000 taxable income, then you actually pay tax at 0%. But if you move up to 3 million, then the next 2.2 there will be taxed at 15%, or at 18%, or at 21%, or at 23%, maximum of 25%, as far as individuals are concerned. So that is the current rates.
So the issue around 150 million naira proceeds and 10 million naira gains threshold, how does it, what rates apply? So if you, yes, I would like you to
Let me explain
clarify, yes.
Okay, so the provision is to the extent that not all disposals or gains are liable to tax. If what you dispose, this one is applicable to only shares, not all assets. If you dispose of shares and the proceed of sale is not more than 150 million, in any 12 consecutive period, the proceed of disposal, the gain from that disposal is not liable to CGT. Or if the gain that you have made within a 12-month period on selling shares, either in the capital market or anywhere, and the gain is no more than 10 million, that gain is not liable to CGT. That is the exemption that is there as far as shares is concerned, disposal of shares. The additional exemption is that if you dispose of any quantum of shares, whatever the value, and within the year of assessment, you reinvest the whole amount or part of it. If you reinvest the whole amount, the applicable gain on that disposal is not liable to CGT. If you reinvest 50%, then the applicable gain on the 50% will be exempt. That is the provision of the law.
Are there other exemptions that you may want to speak to us about? That's one. Then number two, okay, yes. Are there other exemptions before I come to perhaps if there are compliance mistakes that we may want to avoid?
Yeah, it depends. So there are several exemptions when it comes to capital gains tax, not only on shares. There are several exemptions. For example, like I said, if you invest the shares you acquire within the year of assessment, there is no capital gain. If you dispose of your personal residence, the gain on that disposal is not liable to tax. It is expected that you are not one that is disposing of, your property every day, which means only one is acceptable in a lifetime. If you sell your motor vehicles, as long for private use, and you don't sell more than 2 within a particular year, the gain is not taxable. If you are given a gift, and you dispose it of by way of gift, there is no capital gains tax on that. If you hold asset, on behalf of charities or gains that accrue to a trustee, that gain is also exempt according to section 55. If you dispose of your shares now to a trust to hold it on your behalf, I mean, that is not taken as a chargeable disposal. And so CGT also does not apply. Again, very significant is the fact that gains accruing to pension funds, you know, they also invest in shares in the capital market and all that. The gains accruing to a pension fund is not taxable, is not liable to CGT or any tax. So those are exemptions that we have in the law, among others.
Okay, speak to us about compliance. Are there perhaps any risk that we may encounter around compliance?
So, risk for the taxpayer or the tax authority. Now, for the taxpayer, the government is putting in place, I mean, it's supposed to put in place how to collect the tax. The question is, depending on the asset, like I said, the focus has been on shares, but this law is not only focused on share, it is all chargeable asset. And chargeable asset is a long list, except those ones that are not chargeable. We also have exemption. So how do you pay the capital gains tax? As a company, when you are filing your corporate tax return, and you have also made a disposal of assets, you are supposed to compute your capital gain separately from your other income. At the end of the day, because they are also liable to the same rate, you can add the two income and gain together and assess them at the corporate tax rate. But of course, because of certain provision in the law, it appears that the gain on disposal of assets or shares must be done separately, so that there are certain restrictions as to the expenses that you can deduct from the disposal of shares, from the disposal of assets, and the expenses you cannot deduct. The deductible expenses are those that are specifically for the purpose of the disposal or cost incurred for the purpose of the acquisition of the asset being disposed, or the applicable asset, the applicable cost of the asset that you dispose. Okay, so that is why for a company, it is straightforward. When you make disposal, it is going to be reflected in your books as a disposal, either in your cash flow statement, in your statement of financial position, you will see disposal, all right, or by disposal of your investment, which will be reflected in the company's account. So it's very straightforward. When you're filing your return, you definitely have to file, you also have to compute the capital gain. For individual, it's a little bit more difficult because it is the company that is, it is the individual that is.
Another one. I don't say long.
Okay, so.
Okay.
So that.
Start time.
Yes. I'm getting some kind of interference. I don't know where that is coming from. But Mr. Folorunsho, I hope you're still with me. I hope you can still hear me.
I can still hear you.
Okay.
But there's a distortion.
Yes, there's a distortion, so I guess we should be able to fix that quickly if it's coming from our end. All right. How do you think that this new CGT regime would impact, competitiveness moving forward? Because even at the beginning, when you started talking, you did mention, you gave the global example. So how do you think that would this improve Nigeria's competitiveness? That's one. Then number two, do you think that this would even improve revenue for government moving forward?
Okay. So in terms of, let me start from the last question, the last part.
Yes.
In terms of revenue for government, definitely it is expected to increase revenue for government because before now, there has not been serious focus on capital gains. Only companies majorly pay when they dispose of their asset or investment. And the fact that companies are still within the bracket and they are fully captured by the account that they prepare, because the rate has increased significantly, that is also going to generate a lot of revenue for government. Again, if you go to the shares, of course, we talk about both portfolio investors, foreign investors, local investors, and play in the capital market. Of course, when you make disposals of shares and a lot of people do buying and selling of shares, they are all captured as part of either, whether you take it as trading income or you take it as capital gain, they all come under the same rate now. And that is why the arbitrage has been removed. And therefore, it is expected to generate a lot of revenue for government. But the key issue which has impacted the capital market is the fact that a lot of investors are also, concerned that the rate has jumped from 10%, that is going to end by 31st of December 2025, to 30%. It is significant.
That's a significant jump. Yes.
It is significant.
Do you think that will take away investors from the capital market? Do you think that will pull off people?
Well, it depends on the purpose for being in the market. If you are in the market for short term,
the purpose, Mr. Folorunsho, is to make profits now. That's number one.
Yes, if you are in the market to make profit, if you are there to dwell for some time, it may not, impact you immediately, because you are trading and as you are making more money, you are investing in the market. That is going to expand the market. And until you pull out without subsequent reinvestment, before the issue of the tax impact will hit such a person. But for short-term investors, for short-term portfolio investors, this is very sensitive. And that is why government is already looking at other possible ways to ameliorate the possible impact, such as allowing, the grandfathering of the cost, which is applicable to, which is practiced in some other jurisdiction. In Nigeria, we don't have a way of removing the impact of inflation, which we call indexation allowance, that is in other jurisdiction. To be able to tax the real gain, you need to be able to remove the inflation effect. I hear that that may also be one of the considerations to be able to reduce the impact of the capital gains tax on investors. One, to grandfather and benchmark the cost to 31st December 2025, which means regardless of when you acquire your shares, the cost will be taken as the market value as at 31st December, so that it is only the increase in the value or the proceed of sale above the market value that will be taxed. If that can be done, that will definitely remove this fare. Again, there are some expenses that are classified as only deductible from revenue income, such as if you borrow money to invest in shares, okay, that is usually not deductible. The interest on such borrowing is usually not deductible from gain when you sell the shares. If that can be considered as a deductible expense, but that is not in the law, but I'm sure that can be brought in if there's some amendment in the very near future. Again, most foreign portfolio investors are faced with the challenge of foreign exchange loss. You bring in your foreign currency to invest in Naira. The one you have made, you have started losing, okay? In Naira terms, you may be making gain, but in dollar terms, you may be incurring losses. So if those losses are considered as deductible, that will also that will also support investors and make it more competitive, so that instead of losing the huge investment in the market to other countries, that can be retained, and investors will have more confidence in making the required gain in the long and in the short run. Those are some of the things that I believe can be done. Again, the 30% rate of corporate tax, we still consider it very high, in addition to the fact that you also have to pay a development levy of 4%
yes,
on your assessable profit. Those are the major complaints, and I believe that government is definitely doing something to ensure that those can be addressed as quickly as possible.
Mr. Folorunsho, I said at the beginning that you're a part of the tax reform committee chaired by Mr. Oyedele. Please confirm that before I go over to my question. Yes or no?
Yes, I can confirm that.
Yes, okay, yes. Now. So, as you confirm that, while your committee was putting all of this together, what kind of tax model did you and your colleagues in that committee come together to say, let's adopt this tax model? Because I know Taiwo Oyedele very well. He's appeared on this show for a very long time. He's been a guest on this show for many years, even before it got disappointment. Where am I going to? I know that Taiwo is also experienced. So I want to know which country model you people used. For example, the UK, they tax their citizens out. The UK is tax. US, for example, while the US taxes citizens, it still enjoys keeping money in the hands of the citizens to spend. Because when citizens spend, the economy also grows. People manufacture, they have in mind that, of course, people will buy and all of that. You have also the French version. Coming to Africa, perhaps Kenyan version and all of that. So which country did you people look at and say, let's adopt this? Because even the way we are looking at it now, Nigerians are feeling, Mr. President, Mr. Tinubu and his taxes, he wants to just tax us out of existence, even though with these new tax reforms, we've been told that low-income earners, minimum wage earners and co will not even pay taxes. So I would like you to explain that, because I've been looking at it, and I said I will ask Taiwo too. This same question, when I see Taiwo too, I will also ask him. But as a member of the committee, please answer.
Okay, so the focus of the tax reform is for simplicity and to ensure that only income and gains are subjected to tax, and ensure that capital, are not taxed. Okay, and when you talk about the model, the model is also to simplify and align with other jurisdictions, so that the issue of base erosion and shifting of profit from Nigeria to other jurisdictions are also addressed. And that is why Nigeria, being one of the 140 countries, that align with the inclusive framework, the OECD inclusive framework, okay, consider all of this in determining what model to apply. Number one, if you look at the VAT we have has always been more or less like a sales tax, okay? And sales tax because you are not allowed to take deduction for all the cost, all the input VAT that you suffer, okay? So this reform has ensured that companies are allowed to take those deductions, so that what we have is now a real VAT. Real VAT means that it is only the tax on the value addition that goes to government. When you have the input, you deduct it from the output, the difference goes to government. That is a model. In terms of income tax, the original conception was to ensure that the income tax rate, is brought down significantly, even below the 25% that we're talking about, okay? Maybe around 15, 18, 20, so that it can align with other jurisdictions where focus is on transaction and not on profit, okay? So that it's more or less an indirect tax focus, so that VAT will be the main thing, the stamp duty, the personal income tax, so that companies can actually grow. But, by the time the recommendation was made, there was pushback that you cannot increase the VAT rate, okay? And if you truly want to practice proper VAT, a 7.5% rate where you are also allowed to take deduction for your input is not workable. And we are likely to see the impact as soon as the law takes effect on 1st of January, where you take all your deduction, government is definitely going to be out of pocket. The expectation is that maybe VAT will have gone up a little bit, and then the corporate tax rate can be brought down. Yes, significantly. And if that has happened, the issue around the rate of CGT or the impact on gain would not have been this high as it is now. But so that is the model that was put forward. Considered. But you know that the committee do not pass law. You also make recommendation through government to the National Assembly, who passed the law and assented to by the president.
But Mr. Folorunsho, if I remember, even that time there was controversy around bringing up the VAT. I think that was it early this year too, or so. That controversy was there, because if you bring up VAT, if we have a higher VAT rate apart from 7.5% now that we have, that will impact almost everybody. So I think, yes, I think that was why that furore was there, that everybody had to kick Thank you for making it up to this minute watching the video. Thank you all. Don't forget to subscribe to our YouTube channel, Moneyline with Nancy TV. Like, follow all our other social media platforms where we keep you up to speed with fantastic interviews, as well as markets, personal finance, business, and economy information. This is the best place to be. I'll see you all again in the next video.